Hi guys, I'm Ryan Mack and welcome back to another episode of The Trading Guys. In this video, we're going to be going over and teaching you how to handle your emotions when you're trading, okay? Because 10% is finding a trade, 20% is managing the trade, and 70% is managing your emotions while you are in the trade. That's where most people who fail at trading, that's where it goes wrong. Not that they can't trade, it's that they can't handle their emotions. When you're trading, it's actually set up in the same kind of way to trigger you psychologically, the same way that betting and gambling actually does, by the candles moving at certain sizes and certain speeds during a trade, or during certain portions of a trade. The market maker wants you to feel as if, oh God, look at that candle flying. If I don't get in now, I'm going to miss out on this trade. So he's trying to entice you, he's trying to induce you into stepping into the market and making an order, whether it be a sell order going down or whether it be a buy order going up. He wants to make you commit your funds to doing that. And he does that emotionally by playing on your psychology, by making candles fly and what's also known as a fake out or a fake move. Whenever I see a candle flying, it doesn't make me want to get in. I was always taught when you see a candle moving at good speed, that's a warning sign. That's not a sign to get in. That's a sign to take a step back if you were about to get in. Okay, and that's where it differs. So we're going to cover emotions. So what you'll find in trading is, let's say, you're waiting for your entry, right? The market comes up, candle's looking like this, and it's, gives you this double top, comes back down, gives you a bit of this, comes up, misses here again, doesn't quite break this, and then this one here, the next candle starts to go like this, bang, bang, like that. Now, if this moves quickly, that's a warning sign for me that, I've already missed it, just wait and see what else it does later on, or move on to a totally different pair. But the market makers do this on purpose, because you'll have someone here, or you'll have tons of people here who see this as momentum, and it's really just a fake out, it's really just a fake move. And he's pulled this in, and what he'll do next, the next candle will literally just pull straight back up, and it will just wipe you out, and that's what you're trying to avoid. So you want to control your emotions. When you see these fast moves, just don't think to yourself, God, I better get in and enter a trade quickly. Don't just take a step back and be like, whoa, okay, if this has already happened, if these two have already flown, think to yourself logically how the market moves. If these two have already flown and started tanking, what do I want to see now? It doesn't mean that you can't get into this trade, but to be safer, do not get into this trade now, because what is the highest probability? The highest probability on the third and fourth candle, you're going to see a pullback. Why? Because the market always does that. It does the same moves over and over and over again. So after the first 2-3 candles, it will give you a pullback to hit any stop losses of people who got in here, and the stop losses are just round about here. See, my stop loss would be here, so I'm always going to be okay. But most people are taught, when you get in, put your stop loss, 3 to 5 pips behind or 10 pips behind your entry. So the market maker can just come back up, hit your stops and carry on. And if you're one of these traders who places trades and you're always saying to yourself, every time I get in a trade, he always comes back and hits my stop loss, and then he goes in the direction that I already knew he was going to go in. It's because of your stop loss placement. Look, if you enter a trade here, right, and your stop loss is here, the market maker can come back and hit you, and he's still trapped all of this money up here. He hasn't released much money to come back and get everyone who has a stop loss here and take their money and then carry on running. If your stop loss is here above the previous highs, right, for the market maker to come up all the way up here to hit your stops, in doing so, he's released billions of dollars around here, just to come up and collect your $50, your $100, or whatever your stop loss is. So why would he do that? He wouldn't do that, is the answer. He only comes back to get you and chase you because your stop loss is in the wrong place. And to come back and get you on a pullback and take your money, he doesn't have any risk, because these will all be fresh orders. So he doesn't have any risk to come back. But up here, he's got tons of orders that have got in buy orders going long, and he doesn't want to give them their money back. Billions of dollars. So That's why he does it. So managing your emotions, when you see as I said, when you see these powerful, these fast-moving candles, I would say, don't see it as an opportunity to hurry up and jump in before the trade runs, because it probably won't run. It will probably come back. So if you see fast-moving candles and you think, whoa, take a step back, okay, my analysis, I still believe my analysis is correct, and it's going to tank and, go for another 150, 200 pips, whatever. What you're then looking for is your next entry point. So where would your next entry point be? It's not going to be on these candles coming down. Even if the next candle continues to run, you're not going to enter on that, because you will always have a pullback. So your next entry point that you are patiently waiting for to enter this trade is going to be when you see a pullback and it comes like this. Your entry point is going to be here with your stop loss up here, and he's going to fly down. Your first kind of take profit is going to be at the previous resistance. So around here, you're going to close either 50 or 80% of your position. You're going to move your stop loss to break even, and then you're going to leave 20% to run from here to run down. That's your safest way to trade in risk management. And just remember, why do we close positions? Because if you get down to here, and you could, let's say you're in $200 profit, and he then has another pullback and you're instantly minus $80, you're going to be saying, oh, I was up $200, now I'm at minus 80. Yeah, well, you can avoid that by closing off your position here. Closing 80% or close half your position and moving it to break even, because that way you've made money. I always do 80%. Some people like 50. I do 80 because I like to capture the bulk of the money when I know it's a guaranteed thing. The only money that you can guarantee that you have in trading is the money that's already on your screen. You can't say that it's going to run another 100 pips, so I'm just going to wait, because you just believe it as the highest probability it's going to run for 100 pips, but you don't know that. The only thing that you know is right at this moment in time, you are up $200. So what do? You have to make the conscious decision to take some of that money so that you don't go back into the red, because you can very easily go back in the red in one candle. So close your positions out. Close 80%, move your stop loss to break even, and let 20% run. If it runs, happy days. You've made extra money. If it doesn't run and it pulls back instantly and starts going in the opposite direction, which it can do, it can start doing this and start going up again, then you are not in the red. You haven't lost any money. But why? Because you closed 80%, you took 80% of your money, you moved your stop loss to break even. So even though it came back up and stopped you out, you didn't lose any money when it stopped you out, because you were at break even. It's a free trade. And then he has ran up. Happy days. You're still in profit. How many times have you got into a trade you haven't closed off, a percentage? Let's just go with 80% because it's what I close. You haven't closed off 80%. You saw this little pullback and you thought, yeah, it's just a pullback. It's going to tank after it. And it doesn't tank, and it immediately pulls back in one or two candles because he whips it away, because he wants to hit your stop losses. He whips it away, and where you were previously, up $200, up $50, up $500, whatever you were up, you're now in the minus. You're now down $150, $200 because you didn't secure any of your profits, and you're saying, oh, I should have just taken that when I had the chance. Well, you can't. You can close it all if you wish, but you always want to be, when it's going in your favor, you always want to try and maximize on your winning trades and minimize on your losing trades, right? That's the whole aim of the game. So if you close 80%, leave 20% as a runner, which is risk-free with a stop loss at break even, happy days. Your runner, I would say, only 2 to 3 times out of 10 times, your runner will actually run and make you more profit. 7 to 8 times out of 10, it's going to come back against you and it's going to stop you out at break even. But those, 2-3 times where you actually get the runner and it goes, it can tank. Sometimes you can get an extra 200-300 pips on a really big run between pairs like GJ, that's pound Japanese yen, and gold, and also pound Aussie dollar. They all give really, really big runs. So yeah, they're pretty fantastic. Pound Swiss franc is another pair that I trade, but the pairs are the runs aren't as big. If the candles are this, let's say from here to here in GJ, right, just for example, is 85 pips. The the same length from here to here on pound Swiss franc is only going to be, 36 pips or whatever. So that's why I like trading mostly pound yen and pound Aussie dollar. Pound Swiss franc I jump on the odd occasion, and that's the only 3 pairs that I trade. Okay, so other things for managing your emotions, like I covered in one previous video briefly. If you cannot place a trade and immediately turn your computer off and go to sleep, and have a good night's sleep, not waking up every 2 seconds, checking your phone to see if your trades came in or your trades lost or whatever, that means your risk is too high. Even if you're only risking 2%, if you cannot go to your bed after placing a trade without that feeling of anxiety, without having to check your phone every 5 minutes, your risk is too high. So just drop your risk. Drop it to 1% per trade. Or even if you're not confident enough yet and you're still in the learning phase, a learning phase in trading can be 1 to 2 years, guys. It's not a quick fix trading. There's so many things, pardon me, that you have to go through. Just make it 0.5% or 0.25%. Make your risk so small that if you do wake up and you have a loss, you really don't care. Even if your loss is $10, if you're someone who's going to wake up and you've lost $150 in one trade and you're absolutely devastated, that means your risk is too high. Make your risk smaller until you become more confident in the markets, okay? Now, here's the thing with trading, right? It is a process. Now, we have our own trading setups and signals group, our own trading community that people subscribe to, and we teach them how to trade. We teach them how and why we're taking trades. We teach them how you look for your entry points, how long you stay in it. We teach them the whole thing. Plus, whenever we personally enter trades ourselves, we give you the trades that we are entering previous to that. So instead of just giving a signal, say, get in now, we tell people, okay, guys, and we're looking at GJ right now. It's potentially going to give us a double top. If it gives us a double top around this area here, rejection point here, and it starts tanking and going short, then our entry point is going to be around, 156,018, for example. And then later on, maybe 30 minutes later, when it gets into that region, we then tell them, right, guys, we're now in a sell order, GJ, price, entry, this, stop loss, this, take profit 1, this, take profit 2, this, take profit 3, this, and we guide them through it. Now, here's the thing. I can guarantee you right now, right, and I've done it myself, so I'm talking from my own personal experience as well. If I wrote down a list of 20 things that you should never, ever do when trading, right, I will guarantee you, I don't care who you are, you will do those 20 things that I've said. Do not ever do this in your trading career, whether it's right at the very beginning or all throughout it. And I've done it myself, Yeah, so if I wrote down 20 things and told you not to do them, I guarantee you through your trading, cycle, the beginning of your trading cycle where you're learning, I guarantee you 100% you're going to do the things that we tell you not to do. Don't overtrade. Don't get in a trade when the candles are flying. Wait for the pullback. You won't wait for the pullback. I guarantee you'll get in. It'll pull back, bite you in the ass, stop you out, and you're going to go right away. Oh, man, that done exactly what they told me it was going to do. Yeah, but it doesn't matter. Whatever we tell you not to do, I will guarantee you will do it. Everyone does it. I done it. I was told 100 things not to do, and I done every bloody one of them. Don't chase money. So, if you are up on your account, don't just think, I'm going to keep chasing the wins. Don't trade that way. Don't chase money in trading either. Just focus on getting your trades right. Focus on being a good trader. Don't think about the money, whether it's $1 or $1,000 that you're up. Don't focus on that. Focus on getting your entries correct, reading the patterns, reading the trends and directional biases, reading all the different indicators, confluences, but gaining confidence in your own analysis. And once you become good at trading, the money then just follows. It just necessarily follows on from that. So don't chase money. That's the biggest thing where people lose money is because they've had a good week. Here's where people go wrong. So let's say you have a great week, and as my good friend and business partner Lee always says, we become a victim of our own success, right? And it's so true. So what happens is Monday, you trade 2 lots each trade, right? Monday comes, you win 2-3 trades. Tuesday comes, you win 1 trade. Wednesday comes, you win another 3 trades. Thursday comes, and you're starting to think to yourself, man, I've won 5 trades at 2 lots. I'm smashing this. And you become overconfident. And you just think, oh, I'm right. My analysis is bang on. My entries are bang on. My take profits are bang on. So what's the point of me trading 2 lots? Why don't I just trade 5 lots instead? Because I know that my trades are going to come in. And then what happens is that one trade that you take and you have more than doubled your risk by going from 2 lots to 5 lots because you think you're going to make more money, i.e. being greedy. That one trade will be a losing trade and it will wipe everything that you've made through the previous other days on that trade because your risk is so much higher. So, and then what happens, first of all, please don't do that. But I know you're going to do it because everyone does. So then what happens is because you've done 2 lots, 2 lots, 2 lots, you've then traded 5 lots, it's bit you in the ass and it's totally wiped out the previous 3 days of profit. That's then made you too scared to trade 5 lots again. So what happens then? You instantly, I'm not trading 5 lots again. God, I lost so much money. You instantly go back to trading 2 lots because it's where you're safe. And then it's going to take you about, 5 or 6 trades to make that money back potentially, depending on where you can do it in 2 trades, maybe even 1 trade. But that depends on various factors, where you take your profit and so on. So it can take anywhere up to 5 or 6 trades for you to win that 1 loss back. All right. And then you go through this process of, it's just a nightmare. And then what happens is you continue to win more trades, again, at the 2 lots. You will not have learnt your lesson from the first time and you're going to up your lot size again to 5 or 10 lots or whatever. You're going to have 1 losing trade. It's going to knock you on your arse, take a big chunk of your money, and you're going to think, I'm back to square one. And it's because you haven't listened to yourself. You haven't learned from your previous bad experience, and that's what trading's all about. So I can sit here and tell you, right, whatever lot size you do, if you have a loss, don't increase your lot size or don't decrease your lot size. Just stick with it the whole time. I guarantee you won't do it. You're going to go through the mistakes in the example that I've just given you. I will guarantee you that right now, okay? So another important thing is stop trading on your feelings. Like you have to be able to look at the markets, look at the candles, look at the trend, look at all the different support and resistance. You have to look at, all the different time frames, the 4 hour, the 1 hour, the 30, the 15 minute, and so on. And you have to be able to read that in a way because the candle patterns are telling you a story of where they're going to go. So let's say, for example, you have this, right? Let's say you have something similar to this. So here, this here is a resistance, this is a resistance, this is a support, and this is a support. What you'll find is, more often than not, as this comes back down, it will come into resistance at the same. So you can come on here on the next one, and you can draw a line all the way through here, and you will notice that obviously this part hasn't played out yet, but when you draw the line, as you're watching this play out, you will see that it comes some resistance. Look, rejected, tried again, rejected, tried again, and broke through. You will find that happens. And the more that you do resistance and support lines on your trading view charts, which I'll cover in the next video, the more you'll see it happening. Like, it doesn't happen every single time. Sometimes it just runs. But the highest probability, and more often than not, is that it's going to come in, it's going to do this. And when it gets to the next part, look, when it comes to here, it's going to come down, it's going to bounce around, and then it's either going to fly, or it's going to get rejected, and it's going to start coming back up. And these are going to be key points that you'll really see. And I'll show you on the screen in my next video. So, don't trade on your feelings. Go by what the candles are telling you. So, don't come down here and see this rejecting twice, right? Because this might go like that. I'll rub it out. This might come down here, reject, come up, and it might go like this and come higher. And you start saying, oh yeah, it's rejected. I had a feeling that it was going to reject there. I've got a feeling that it's going to go long now, yeah. But look, what you forgot is there's another resistance up here. So what you might find is it comes up. So you now get out of this trade, right? And you now put in a buy order going up, and you place your stop loss down here, right? Let's say your stop loss is going to be here, roughly. You're basing on your feelings, but what you haven't taken into account is it's approaching this resistance area. If it passes here and cracks on, happy days. But look, if it comes here, you have a higher probability that it's going to reject here and then tank. So it's going to hit your stop loss and it's going to keep running. What you want to look for in support and resistance areas is you want to enter on what we call the retest, right? I'll show you what that is now. So let's say this is coming down, right? And you've got this here. If this just keeps running straight, you don't want to enter on any of that because it's going to pull back at any time. What you want to see in order for you to be able to say, I'm going to enter here, is you want to see it retest. So you want to see it come down, get rejected from here, pull back up to roughly, it doesn't have to be bang on this line, but it will pull back up around about this area here, get rejected, and then come back down. And then as it's coming down, I personally would bang in an order here at a very small risk, like I said before, on a dynamic risk. And then as this passes here, I would close a percentage of that trade and I would scale in here as well to take that coming down. So you want to see it pull back. You don't want to enter anywhere here as it's just running, nowhere at all. You want to see it pull back first and keep running. Now, there'll be many of you now thinking, talking to the video as you're watching this, saying, yeah, well, what if it doesn't pull back? Well, if it doesn't pull back and it keeps running, just ignore the trade. Don't bother getting into the trade. Just bin that trade off for the day. Or you could wait until the trade finishes out, because what it'll do is it'll give you a little pullback, right? It's called a counter trend trade. So this is the trend. When it finally bottoms out, it's going to give you a little pullback like this. And then it may pull back again and it'll just break into consolidation. If you're a more experienced trader, then you can just wait until it bottoms out and you're going to get 2-3 candles, which can be, 25 to 40 pips on GJ. You can trade this area here as it bottoms out, and there'll be various telltale signs on that, which is candle patterns, and I'm going to cover that on the next video, all right? And I'm going to show you that on the screen. So that is, if you're a new trader, I don't recommend that you do any counter trend trades. A counter trend trade would be like this is a trend trade because you're trading in line with the trend, okay? A counter trend trade would be from here to here. I don't recommend that you do that if you are a beginner trader, because obviously the moves are too quickly and you're probably going to get stung. Yeah, and when it comes to trading, guys, listen, be prepared. It's all psychology. You have to be prepared for good days, bad days, good weeks, bad months, good weeks, bad weeks, good months, bad months, and so on. You have to be prepared for that. That's what it doesn't matter how long you've been trading. So I've been trading for almost, I would say, I learned trading, 6-7 years ago. I've been actively, trading full blown for different companies now for the last 5 years. And for the last 7 weeks previously, these last 2-3 weeks have been going great. But the 7 weeks before that, I just seemed to be in this block of the market just kept pounding me. It wasn't that we're having losses. I was having losing trades and winning trades, but I was just trapped in this vicious circle of I would always just break even all the time. So at the end of a week or end of a month, even though I've had both winning trades and losing trades, the account was neither down in a negative or up in a positive. It was always just break even, and it was driving me nuts. And I'm thinking, I've been trading for years. Like, how have I suddenly just came into this bouncing around for weeks and weeks on end? And it really affects you mentally as well. So just be prepared that I've now kicked it and we're now rolling again. But you just have to, what I did in that situation was, in the army, we call it having a Condor moment. So a Condor, as you know, is it's a big bird, like a vulture that just soars, right? And it looks around for its prey and so on, a carcass or whatever. And we call it having a Condor moment, when you just kind of take a step back from yourself and you look and you analyze yourself and you say, what am I doing differently now that's given me these results of just, winning trades and losing trades and just sitting at break even as opposed to being in profit? What am I doing differently? And it was various things. So previously, when I noticed, you know what? Instead of doing dynamic risk and going in half a lot, and building it up that way, and keeping my risk very low but the higher potential reward, I was going in with static risk. So I was jumping in with like 3 and 5 lots instantly, which is only 2% of the account. That's still absolutely fine, even when you have a loss. but I was jumping in instantly. And the minute you then have a loss and the account's down $600, you're like, it affects you because $600 is a lot of money, even though it's broken down between all these people, you know? And it just really has this effect on you. So first of all, I had changed my trading style from doing dynamic stop losses, dynamic risk, to static risk. So right away across the out, I said, right, from now on, no more static risk. I'm not entering on my full 2%. I'm going to enter on dynamic risk, half a lot, half a lot, half a lot, and so on. I'm going to go back to what I was doing, for the last previous years. Also, instead of securing 50% of my position, instead of securing 80% of my positions, I had started securing 50% and leaving 50% to run. So my profits in the initial big runs were smaller. I was taking less profits than what I had previously been taking, because I used to always close 80% and let 20% run. But now I had changed it. I was only taking 50% and letting 50% run. But more often than not, you don't get a runner. You very seldomly get a runner, and you're just holding on for the one or two times that you actually do. So it was coming back and stopping out at break even. And then when you had the losing trade, the loss was more than what you gained on the previous winning trade, because you only took half of the money. You never took 80%, the bulk of the money, you see. So there was the second thing that I was doing differently that I had never ever been doing before. I had changed things that were working for things that I thought would work, and they just didn't work. What else did I do? I had too many pairs. Pardon me. I was focusing and looking at far too many pairs. If you looked along the bottom of my trading screen, there was about 20 pairs there. And what used to happen was I would be clicking through all these different pairs to see what was what. And maybe out of 20 pairs, I would spot 3 that I liked, right? And when you're looking between these 3, you end up missing trades. So because you're focusing on, GJ, and it still hasn't done anything yet, and you go, 5 minutes later, I better check pound Swiss franc. You jump on it and it's already ran, a massive candle, and you think, it's too late to get in. So focusing on too many pairs, it distracts your mind. It takes your mind to all these different things, and you end up missing perfectly good trades that you didn't have to miss. So what I did, I binned all of my pairs, and I kept 3 that I like to trade because they give you the most amount of pips. One of them is GJ, pound yen. The other one is pound Swiss franc. It doesn't give you that much pips, but it's quite a nice steady trade. And the other one is pound Aussie dollar, which gives you a lot of pips like GJ and gold. So I trade 3 pairs now. That is it. I broke down my trading time. So instead of just sitting in front of the computer all day long, here's the thing. If you sit in front of your computer trading all day long, you literally sit there for 6 to 8 hours a day, maybe even more, and you're constantly in front of the screen, minus getting yourself something to eat, drink, or going to the toilet, and then you're straight back on it, you get what's called chart vision, and you just start to see candles everywhere. And you essentially lose your ability to be able to distinguish chart patterns, i.e. double tops, triple tops, head and shoulders. I mean, a head and shoulders is very prominent. It's very easy to see. A double top looks like the letter M, very easy to see. Double bottom looks like the letter W, very easy to spot. But when you've sat in front of your computer the whole day just looking at a screen, they then become very hard to identify, because you get what's called chart vision, and everything just kind of molds into one. So it's very important that you choose your sessions. So I wake up at between 6 a.m. and 8:30 a.m. I sit and watch the Asian session to see if there's anything to take. And then I leave the computer. If there's nothing by around 8 a.m. that I see, I'm like, there's nothing's really happening here. I'll just walk away. I then come back to the computer for pre-London Open. So London Open's at 3 p.m. my time in Jakarta. Okay, I don't know what that is for you and what country you're in. So I know that London Open is 3 p.m. in Jakarta for me. So what I do is I sit in front of the charts by 1:30, 2 o'clock, because pre-London, you usually get quite a lot of good trades on pre-London and with the London Open. So I come back to the charts around 1:30 in the afternoon. I can do loads and from 8:30 to 1:30. So I trade from then 1:30 potentially up until around 3:30, 4 p.m.-ish, maximum 4:30. And I then know, if I've traded or if I haven't, that I then need to next be back at my computer for around 7 p.m. because New York opens for me at 8 p.m. So I come back to the computer an hour before so I can have a look at my charts and get a feeling for, do my analysis and get a feeling for where I believe my next move would be. Am I looking for buys or am I looking for sales? And that's essentially it. And it's very important to do that because you don't get chart vision. And we'll cover that more on the next videos, okay? So, as I was saying, lads, we're going to wrap up here. Emotions, don't get trapped in your emotions of trading because it's designed to do that. It's designed so that when you see these runners, you go, oh, it's momentum. No, it's not momentum. It's more often than not a fake move, and he's going to trap you in. He's going to whip back and stop you out. So just remember, when you see a fast-moving candle, don't see that as an opportunity to, oh my God, I'm going to lose this. I'm going to lose out on making money here if I don't get in. Just see it as, whoa, it's danger. It's a dangerous sign if a candle moves fast. What you want to see is slow and steady is good. Fast is dangerous. You don't want fast candles at all. So if you see a fast candle, what are you waiting for? You're waiting for it to come down, hit a support and resistance area, pull back, and then run again. You're going to get in round about there. Just ignore all the white noise in between because that is his job. His job is to make you have a fear of loss, i.e. losing out in the trade, not making money, and then here, he'll just pull back up, wipe your stops, and he'll probably even just run again. So as he pulls back up to wipe out people's stop losses, as he comes back down to run, that's when you want to get in and you want to take it running short, okay? I'm Ryan Mack. Thank you very much for watching the trading, guys. If you want to hit us up, you want to join our setups, you want to join our private community where we teach you how to trade. We also give you the exact same trades that we personally take so that you can earn money by copying our trades while you're learning at the same time. We call it earn while you learn. It's not just signals, forget that. It is setups and full-blown education. We have tons of videos that you can see. You can check us out on all social medias, Facebook, Instagram, Snapchat, YouTube. We have it all there. And you can check us out on www.thetradingguys.com and you can come and be a part of our trading community. All right. Thanks, guys. See you next video.